Hello, everyone. Welcome back to the Prospero.ai stock market live streams. Good to see JC in the chat already. Good morning to you as well. Let me double check that our Twitter live stream is working here as we start today. Looks to be good. All right. Well, everybody, we've had another eventful weekend. A lot of headlines, a lot of things affecting the markets. Things are moving huge here as we are opening up today. Let's take a live look at how the QQQ, SPY, Dow, and Russell are performing. They're trying to make a little bit of a comeback rally here as we're starting the stream. After hitting the lows of the day, the QQQ is now down about 0.4%. SPY 3/4, Dow Jones 1%, and Russell about 1.33% down on the day. The VIX is actually red now at the moment and below the 30 level, which it had eclipsed on Friday, and then early today it was over 30, but now we're at 29.19 for the VIX. So a little bit of buying the dip in the market at the very moment. The Prospero signals have highlighted this weakness very well. QQQ is at 5 in net option sentiment right now. SPY is at 0. Even the XLI and XLK, which we've kind of started looking at more recently, are now pretty low as well, with the XLI at 12 for net option sentiment and the XLK at 6. So it looks pretty bearish in the signals still. A lot of people have been positioning for this weakness. It seems like a lot of what you read, a lot of investors are bearish at the moment. So I think what I want to try and highlight today is the inverse side of that. So I'll be asking George if enough weakness has been priced in for a lot of these things, if we're going to see a rebound at all. One of those areas of the market that is ripping is oil. USO was up to over 130 per share price in the pre-market, and it was actually halted. Um, Ever since then, it hasn't quite hit those peaks yet again, but let's see where it's at today right now. It's at trading at $119 per share. So we have to talk about the oil price rise, the impacts that it could have on inflation, the friction that it could cause for the economy. It seems like people are starting to price in a possible recession now because of the events that we're seeing in the markets. So do we think oil prices can stay this high? Will there be a quick surge and drop? How will that affect the markets going forward? We are also seeing outflows for the QQQ greater than the highest in the bear market post-COVID, so 2022, 2023 timeframe. The outflows in the QQQ just surpassed them now. So you're seeing the action that people are taking in prepping for some weakness. But typically, when you're seeing peaks and outflows, you can only, revert to the mean of, going the other direction. You can only stay at peak outflow for so long. So maybe we're setting up for a little bit of a rebound, even if it is a short period of rebound in the markets before even going lower. Another thing that seemed to really surprise the markets on Friday was the non-farm payrolls coming in negative when the number, and not just negative, quite negative, negative 92,000 for February. So job weakness, oil spiking, macro and geopolitical tensions is like a massive mess for the market. Mario's in the chat. Good morning, Mario, to guys and gals. So I guess you could say, which we have been saying, the markets are still holding up, as well as you could hope for or expect with all of the things being thrown its way. One of the favorites in Prosperos for our regular viewers of the live streams, obviously know this, ASTS. I didn't realize, and I came across a story that Google is one of the largest shareholders and investors in ASTS, which I found fascinating. And of Google's $2.6 billion investment portfolio, ASTS is 25% of it. Actually, so maybe Google isn't one of the largest investors in ASTS, but ASTS is one of Google's largest positions. So interesting to see there. And I'm wondering if that position by Google is, and that ongoing holding is part of the reason why we're seeing ASTS signals so sticky in terms of strength. And I'm going to ask George about that and what he thinks of. I think he thinks of Google and their tech and their vision, uh, highly respectful of them. So the fact that they are holding ASTS, it's got to be a good sign. Then Every dog has their day. Hims is short squeezing today, up about 40% at the moment. I think I saw it as high as like 55% at one point this morning. They have ended their feud with Novo Nordisk. They were getting a lawsuit from Novo for selling the fake weight loss GLP-1 drugs, the compounded versions of them. It looks like that feud is over because Novo did not only end the lawsuit, they are going to be selling their drugs on the Hims platform. So it's kind of like a partnership as well. So we're seeing the stock react. It was massively, massively, massively shorted before this news, which came out very late on Friday. Um, so is this a sustainable rally? Is this the beginnings of a major short squeeze? A lot of people who have been probably losing money on Hims are pretty excited at the fact that it's so shorted, and this news caught a lot of people by surprise. So I'll ask George if he thinks we could see now, not just a one-day short squeeze, but maybe a multi-day, week or two type of event, and if Hims is a buy now, even after it's been up so much. We still have some earnings to go through this week as well. We have Oracle, Kohl's, Dollar General, Dick's Sporting Goods, Ultra Beauty, and Adobe. So I want to highlight Adobe after we covered the Michael Burry story last week for sure. Then we have a few retail names. I noticed recently a stock called Ross, and also I looked at TJ Maxx after that. They've been ripping, and I'm wondering why retailers like that have done so well in the markets. If that's the market's way of pricing in maybe a weaker consumer, recessionary conditions. But if it's time for those stocks to kind of go down, it's been amazing. Let me actually give you guys some performance of both of them. We'll look at Ross first, which ticker is ROST. In the past year, it's up 53%, and year to date, it's up 15% with the market weakness. That's pretty incredible. And then TJX in the past year, up 32%, year to date, up about 2.5%. So why are those names green? Why have they been able to work in a weak market? Mario said a unique non-AI strategy. I guess we've been covering the weakness in the AI stocks and companies. We actually just posted a short video about that. By the way, guys, if you're not checking out the shorts we're posting, we post them on um, TikTok, Instagram, and YouTube. If you ever miss these live streams, or if you just want to catch the Cliff Notes versions of like the best moments of them, definitely check out those. Follow us everywhere. It's all linked in the description of the YouTube live stream. So if you're watching on Twitter, you can head over to YouTube and find all the links. We got the Discord in there that you could join. We got all of the socials. We got newsletters. We got the website. We got it all there. So check it out if you haven't yet. Drop the like, by the way, too, if you have not liked the live stream yet. We're going to dive into these topics in full detail in just a bit when George joins. This is actually a super stream today because we are only doing one stream this week. So we will not be live Wednesday at 3 p.m. like usual. This will be the only stream of the week. So hopefully we get in a lot of topics, and comment any questions you have for us in the chat. We'll be happy to go through them today. Next thing I have for you all is something that seemed to really rock the boat for banking stocks on Friday. This news that BlackRock, in one of its biggest funds, a $26 billion HBS corporate lending fund, had to block withdrawal requests. So they only were able to fulfill about half of what they had. They had redemptions of 1.2 billion, and they only paid out about 600 million. And that redemption level surpassed the 5% quarterly limit. So people really got nervous about the private credit markets, what this means. Why are so many people trying to go through redemptions at this moment? Maybe some stress in the system. So a lot of banking stocks got hit on Friday. Actually, let's take a look at how some of them are doing today. Are we seeing a continuation or kind of a buy the dip going on there? Bank of America down almost 4%, Citi down over 3%, Goldman Sachs down 2%, JP Morgan down 2.5%. So it looks like more fears going on there in the banking sector, which some of them are quite red year to date now. Bank of America is down almost 15% year to date. JP Morgan down over 12%. So we're seeing some weakness in the financial sector for sure at the moment. And I think that dragged down the Dow on Friday, which is catching up to the losses year to date of the QQQ now. So if we lose AI and technology, and then we also lose banking, both of those sectors, it's going to be a tough market probably. I have one more topic to go through today, and this was a poll that revealed that the AI favorability rating is in the toilet. I don't know if anybody came across this level, but only about 1 in 4 people have a positive uh, mindset on AI at the moment, which we've been highlighting some of the negative aspects of AI, at least in terms of, a regular person's perspective of it. I feel like on the streams pretty well, but even this number is a little bit surprising to me to see it so low. With, you know, I would imagine everyday people would still be using AI quite a bit these days. And W said, and that one person likes the cat video. What's up, George? Morning.
Morning.
Happy Monday. Interesting, really interesting market opening today with the weakness. I think a lot of people were thinking today might be the day where we just see like selling throughout the day with all the things going on, oil ripping over the weekend. But the story continues of the resilient market because we're seeing the QQQ down just about 1/3% right now, and by the dipping ever since the morning dip, and everything else is also trying to rally at the moment. We'll see if anything can go green throughout the time we're streaming. The VIX, which had hit 30 for the first time on Friday and then opened up over 30 today, is now down 2.5% at 28.71. So the VIX is dropping. The markets are continuing to be resilient. I don't know if you have any thoughts on what exactly is the thing that's triggering the market so much, or in the number one position, if it's the oil prices rising, is it anything else going on at the moment? Maybe the jobs on Friday number coming in weak. But what are your thoughts on the wall of worries? Like, how would you rank them at this current time, and why the market's again in the red today?
I mean, I think it's oil. I mean, if you look at the stuff, we have a few shorts in our portfolio. I don't know if we dropped the airline one. But we do have Carnival. Yeah, I guess we didn't want to be overexposed, but we did have Carnival cruises. Obviously some exposure to fuel there. We have some consumer cyclical that hasn't been doing that well. But yeah, I think oil is definitely part of it. Obviously with things going up, I think, but I think where it balances out is that we have this constant like push pull in inflation. And I think there's definitely some overall market concern about inflation rising and that making it more difficult with rates. I think that's part of it. It's not just the oil prices, and we see these companies with oil prices obviously being impacted. But I think there might be some concerns about consumer confidence too, right? Like I've been looking around at the pumps as I've been driving around Los Angeles this week, and it's been noticeably higher right away. People see that stuff. I mean, I think we also are in this. I mean, I think it's strange, and we saw it last week. We're in a spot where these tensions are very scary, and I think you had Donald Trump talking about like domestic terrorism potentially, and he didn't even he didn't say that he was expecting it, but he did kind of like reiterate that we would lose some lives over this. And so I think it's going to be hard to see a sustained rally with that kind of drag. But as we saw last week, if things like, I do think the market is in a place where it has like shrugged this off more than you might think, and is playing this conflict as something that could end soon. And obviously the market would rally off of that. But there's also a lot of indications that it won't. And like, I think similarly to what we saw with the shutdown, is we might not see, like, we might be getting some of the narrative of or some of like the probabilistic scenarios to a point where initially we aren't seeing it, like the dominant probabilities or that playing to the downside or the drag being that big. But I definitely think if it goes on perhaps longer than that first like 4 to 5 week estimate, that the government gave, I think we're going to start to see a lot more uncertainty and a lot more, dragging down in the prices.
You mentioned being short cruise lines. Air cruises and airliners are probably the most affected uh, by the oil rises. Would they be like untouchable to you, except going short, like until we see either the oil prices drop or there's a resolution? Any other areas besides cruises and airliners and I guess travel that would be so hypersensitive to the oil prices?
Yeah, I mean, I think there's a lot. I mean, I think there's a long list, especially when you consider um, potential issues with inflation related to oil. Um, but yeah, I don't really have like. I think on this kind of thing, yeah, it's nice to see like second and third derivative trades, but I also think you don't overthink it. I think just like airlines, cruise lines, like you see them going down today. If you want to play it, why not play it like that?
With such a rapid rise in oil prices, we are seeing USO at a 92 RSI about up 71% year to date. Would you get tempted at all to fade this rally in oil or no?
Um, yeah, I wouldn't be betting against it right now. It's like one of those things with at these prices. Like we've been in some of these stocks. We've been in like on the long side, we've been in LNG and we've been in TPL for a bit. I think those are definitely worth hanging around in. Um, but yeah, I think it's tough to take new positions. And I mean, also like we're in a stock like Palantir. One of the reasons we like ASTS too is there's some defense applications that I think now is a good time about thinking about the growth names you can get into that have kind of defense upside as well. I think it's a good time to think about, if you look at our portfolio, there's a lot of thematic things that we're going for right now. I mentioned Palantir, ASTS, LNG, TPL. LEU is not necessarily that's just not necessarily as thematic. I would say same with Microsoft, but Intuit's kind of in the software rebound, software as a service. We've been kind of seeing that. So you could say that, 5 of the 7 longs in our portfolio are really trying to play thematic opportunities that we're seeing in this market.
The reason I asked really about the oil fading is because I feel like Donald Trump has always been like prideful and the oil gas prices being low, like oil being cheap. So I'm wondering where the line will be for him and the administration of like seeing oil prices rise, and if that will actually force their hand to end the war quicker and kind of like be a call on them. So, how do you feel
Well,
about that?
we were talking about like terms for peace, and like I'm not sure. I'm not sure. Like I think if there was good terms to end the war, ones that we could feel like. I mean, Israel is a whole other thing in this. But ones where everybody could feel good about. I think there might be some kind of hurry to end the war, but I don't. I think both sides seem pretty dug in right now, and it does not seem like the strategy of like kind of like decimating Tehran um, has worked. Like, I mean, I think a lot of the senior leadership seems to have gone underground and seem to be very content to start, and continue to, retaliate. Um, so yeah, I think that's why people are saying that it's going to be drawn out, right? Because like there's some situations where you'll do kind of like one of these like shock and awe campaigns, and then it'll work, and the senior leadership will be like, all right, we don't want to fight this war. But I mean, obviously, it's not the same with like Ukraine because Zelensky's been there the whole time. But there, like, we might see some similarities in the sense that, like, there is still leadership in Iran that's intact. There doesn't seem to be a deal to be made right now. And this could get drawn out as a result, right? Because if there's still as long and they've been preparing for this just like we have. And a lot of what you see in those scenarios is they're prepared to live underground and launch, and they have the infrastructure to continue to launch these retaliatory strikes. And so that could be what it's like for a bit. And like we said, We hope that that doesn't include infrastructure to attack American soil, but it also wasn't very encouraging to not see the president, kind of say, well, no, I think we have the proper infrastructure to prevent this. Like when the response to that is like, yeah, we might lose some lives. That's the kind of thing that makes me wonder if I should be living in New York anymore for the foreseeable future. And I don't really like to have those kinds of thoughts in my head.
Well, you left New York, and I'm right next to it, so I don't know. I hope we're okay over here.
I know, but
But
when I'm going back, not too far from Times Square, not too far from Madison Square Garden. So, and I
yeah,
was at a Lakers game last Friday, and there was some real beefed up security there.
it honestly stinks that this is like a joke, but there's a little truth in every joke. It's sad that that's the state of like where we're at now, or you gotta even like half think about that. Um, I had a question for you regarding I forget. So I'll move on to this chart I came across of outflows in the QQQ now surpassing the bear market of like the post-COVID 2022, 2023 era. And even with all of these outflows, you're seeing the QQQ not like react in the way that I feel like we would typically expect in terms of downside movements when you're seeing this much outflow. Now, you know, when there is this much outflow occurring, the only way to really go in the future is like you're at peaks already. You kind of have to revert to the mean, and some people are going to have to buy the dip eventually. So, could we be setting up for a relief rally sometime soon with kind of the bearishness we've seen a lot of investors positioning already? I feel like it's a weird thing to say because the market doesn't seem to have like capitulated or like really reacted crazily yet, but maybe that just shows you like all of the bullish stuff happening in the business world from AI, and it just doesn't have the room to go down that most people like may have thought.
Yeah, I don't know. Like this is still like very much the buy the dip market. We, we were talking about sell the rip too, but I don't think we're in like the full on buy the dip market. I shouldn't go that far, but I think there's still a lot of elements of, you know, retail traders, the momentum that follows that are just like looking at any dip as an opportunity because of how well AI is still doing. And I think this rebound we've seen in software, especially shows that you can always find long value in the market if you're looking in the right places. And I think with all those outflows, I think it's going to be hard for QQQ to say like get above all-time highs. I think there's just too much downside resistance to it right now, unless something like the war looks like it's, like we saw last week, where there's an announcement that people are coming to the table, or it looks like it's going to like end soon. Like I do think that's on the table. But for now, I just think it's a highly risky market.
We are also seeing in the CNN Fear and Greed Index, we just went into extreme fear, now rating at 21 overall. So I feel like, a lot of these statistics, they're showing that people are pricing in fear. And it doesn't mean, I guess, in the short term that it can't go lower or like people can't become even more fearful. But it does seem like we're kind of getting to the, you know, either short term bottom or like pricing in a lot of pain type of situation, at least in like our metrics, even in the QQQ ratings. We've had the perma hedge on that we've talked about. So yeah, I'm just wondering like your thought, like I've kind of brought this up before. It seems like everybody is bearish. I'm wondering um, if people are going to be surprised with some kind of bullish catalyst pretty soon, since people are positioned this way.
Yeah. I mean, I think one could argue that the perma hedge is on because like we talked about this last week, it was not like it was kind of an open secret that something was going to happen with Iran. And I think that until that's settled, I think we might see those perma hedges on, and I think we might have to play the market accordingly. And I think, like I said, I think it's going to be really hard to get a sustained rally. I'm not necessarily sure we're going to see a sustained bull or bear rally, although if we do see a sustained rally, I think it's more likely to be a bear rally, and that's more likely to be tensions escalating. in this situation. But there was a lot like, if you think about how the Ukraine thing unfolded, um, we don't know if we're heading for that kind of thing. Like there's a lot of talk, like we already have seen our foreign policy change. Like we've already seen sanctions on Russian oil being lifted to like make up for, and a lot of the times how these wars work is like, China could be supplying weapons to Iran or money to buy weapons. And, cryptocurrency is very good for that, transferring, and that's kind of what we saw with Ukraine. We saw like other countries, backing them more in secret. And then the longer it gets drawn out, the more that countries officially back them. But this was a risk. This was a known risk. It was called something that could cause World War III before it happened. And, there's honestly no reason to believe that some of these players like China that were expected to step in on the other side, there's no reason to believe that they aren't already in there. And that could be a reason for this drawing out. So, yeah, I mean, I think in a tactical sense for us, what that means is you have to be really careful with how, like, and that's why I think there's more of a drag down to up. You got to be really careful to how much you play these rallies, because it could, one headline can send it going the other way, really fast. And then, we're just looking at volatility, right? The market opened up, pretty bad this morning. And when a situation like that happens, like, yeah, you can see that it rebounds. Some people bought the dip, but on those kind of mornings, it could just as easily be something where, stop losses get triggered and it can go down a lot more.
So I remember my question. I was going to ask you about like international stocks, because there's been times in the past when we've been seeing good signals from Mercado Libre. A lot of people like the stock grab. The China stocks from time to time have good signals. Would you categorize them the same as cruise liners, airliners, like untouchable right now, or do they provide some like hedge of the market? So which way is it? Are they like more interesting or less interesting?
I mean, Melly's looked really bad in like the long-term upside. Like otherwise it looked good in momentum score, but otherwise I would be more interested in it. But like this is kind of what we talk about. Like some of these stocks I really want to have a view on. And I don't necessarily have a view. Like, I imagine like what I'd really want to know for a stock like Mercado Libre, who like obviously has a lot of like is obviously doing a lot of shipping. Like how are their shipping costs affected by this? Because as much as you might say like, oh, they got hit too hard, they're a little undervalued. Maybe even global supply chains will get disrupted. So maybe some people that, used Amazon for some things or used, Temu or any of like the Chinese, maybe that becomes tougher for them with supply chain disruptions, because when you think about how some of these ripple effects happen, it's not just like, is fuel more expensive? It's like, okay, because fuel is more expensive, does it now become cost prohibitive for maybe China to ship some of these goods around the world to the markets that Mercado Libre serves? Or do they still ship them, but that changes the profit margins for Mercado Libre? Like, that's why I look at stocks like that. And without being able to make a good assessment of that fashion, it kind of just makes me, scared to stay away. And again, it kind of goes, want to stay away. And again, it kind of goes back to that low hanging fruit of like, why would you do second and third derivative analyses when you can just say like, oh, if this becomes a problem, a sustained problem, like airlines, cruise lines, much more obvious picks to play the downside on that.
So on Friday, one of the things that probably sent the market lower as well was the non-farm payroll numbers. So the market was expecting gains in jobs for February, but it came in at negative 92,000. And I'm wondering, with that, we're seeing job weakness. We're seeing probably a higher friction of the economy, kind of like how we were just speaking about with oil. Are we heading for a recession? You think we're kind of like in the beginning of a recession, even though it hasn't been determined yet? How do you think? Do you think the economy is about to slow down because of all this? Any thoughts there?
I mean, how long have we been talking about this job loss thing, right? A long time. I think that's a real thing, right? How long can we look at this AI side and say, we see all this job loss. We see that OpenAI graph that we share all the time, and be like, this isn't going to take jobs away. I mean, I think you have to be like, you're lying to yourself if you don't think that we are going to see the impact of this. And I think we're starting to see it, and I think it's only going to accelerate, and that's a scary prospect.
JC said Jan's numbers were bad, but they also revised December down also from positive to negative. So we're seeing some job destruction going on now in the
Yeah.
economy for sure. Now, it seems for a while the tech sector, because of like the high valuations and the way a lot of those stocks had gained, were the weakest in the market recently. We're starting to see the financial sector really to take a hit as well. In the beginning of the stream before you were in here, we were going through like a lot of them are down 10+% year to date. The Bank of America's, JP Morgan's, all of them. And they were all down a lot on Friday because BlackRock, it was revealed that they have one of their leading funds, a $26 billion HPS corporate lending fund. They had a surge in redemptions equaling $1.2 billion, which surpassed their limit of 5% quarterly redemptions. So they had to like deny people, and they only fulfilled 600 million, so about half of their requests. And this got the market really worried about private credit markets. I guess it would make sense now that we're talking about all the job destruction that people would be tapping into that side of things. Actually, now that I'm thinking about it, trying to get some access to funds and money. But are you worried about the financial sector? Like if we already lost tech and then we lose finance, you know, how many sectors can
Well,
go
I mean, I
down?
don't think we've lost tech, but like finance, yeah, I think finance is definitely like it's definitely a worry. Um, in terms of how much stress can the system take, right? And I think especially like when you look at things like private, I would say private equity just as much as like private debt. I mean, but there's some overlap in the two. Like when you look at some of these companies that have certain multiples, right? You're looking at it as a software, like, you look at the software as a service problem. And some people, we like to draw these lines. I think some people don't necessarily make the leap of how important, like the capital markets are to some of these structures, right? And valuations. And if, whether you're talking about, debt, or whether you're talking about equity or whatever you're talking about, if these companies have to get valued down because of these inherent risks of AI, all of a sudden it's harder for them to raise capital, and a lot of them might die. And it could be defaults are up. It could be that these, we're also seeing, we've seen BlackRock, we've seen Blackstone get hit even hard, like and a lot of those are private equity deals that are causing them. Yeah, we're seeing it on all levels. JC makes a good point about the Vanguard thing. Like, I do think not only do people see this valuation strain as an issue and are starting to say like, hey, this, there's a lot of smoke to this. I think we also are in a situation where we haven't yet seen the full impact on, we're even just talking about perception when we talk about the software as a service thing, right? Perception is starting to hurt the price. What happens when some of these like leaner AI enabled companies start to take real revenue away from these more mature companies, which I think is on the way? That's a scary thought to what could happen to these valuations. And, as a result of the valuations, redemptions.
And the NW said 2 years of consistent job losses in Seattle area had tech workers cry in a meeting last week, and they have severance packages. So people are feeling it.
Yeah.
So if people are starting to, do you think there's going to be like a liquidity crunch? Like if people are starting to tap into these private credit markets, like do they start selling their stocks next? Like how does this, is there any kind of cycle to this where one will, get hit after the other?
Well, it's hard to tell that particular thing because it's hard, like, you'd have to know how much of these like redemptions are just a function of not really trusting those private credit products anymore, and their returns, or the alternative to returns, or the risk reward, and how much is because people need the money. The Vanguard stat that we just saw might suggest that people are starting to feel like they really need their money. And like, I think gas prices are, to circle back to that, I think that's a big thing, in that when people start to see those kind of prices go up, it impact their commute. Like, not only do they start having to say, oh, like I might, gas is a big expense for people, especially a lot of our cities are built around, highway driving and things like that. So not only do when people see that on a real-time basis, they're like, oh, I have to redo my household budget, might cause that, like that alone might cause them to feel like they need more cash on hand, especially if they're worried about the markets. And then, you have the added risk of them saying like, okay, gas prices are going up. What might be next to strain? So yeah, I think that these gas prices are, sometimes people aren't that involved in like foreign policy, right? And they don't really, and a lot of people don't even feel like they have confidence to speak on that, or what have you. Obviously, the job loss is a thing too. However, when you start talking about real tangible things that people see, especially like gas prices rising a lot in the short term, you definitely start to get people reacting. You definitely start to get people wanting to kind of like turtle up with their assets. Now, I don't know exactly like we're saying, the extent that people are looking for more assets, or they just are like losing credit and losing faith in these private credit markets. But neither is a good sign.
And Mario said private equity has been under pressure for years because of greed, so don't be surprised at liquidity issues snowballing, going to get ugly. GC, also private credit for retail is different scenario than private credit for institutions. Who is hit
Yeah.
harder, retail or institutions?
Well, there's not necessarily a lot of retail and private credit. My only point there being is that when you start having liquidity issues in some places, it can trickle down to other places, like we're talking about, right? If the same institutions can't get their money, and we made this distinction, right? The extent that they've lost faith in the private credit markets versus just are looking to get liquidity and want to liquidate because they have overall worries about the economy. Those are two different things. But they could have actually the not being able to liquidate the private credit could end up having a worse impact on the markets, because it could cause people to liquidate more equities, and we could find, kind of that snowball situation taking over.
Now I'm starting to wonder, like with the '08 like housing crisis that came from lending, if there's anything like this similar to like the lending that's gone on in any of these areas of the banking and financial world. If there was ever a time for it to reveal itself, I guess it would be now, when there's a lot of pressure on everything, right?
I mean, we'll see. It's what we're saying. I think if this war goes past, right, what are we calling it? Like, I don't think they're calling it a war. I didn't know what the official, if this situation goes on longer than the original estimate of 4 to 5 weeks, I think it's going to get, if it goes on for longer, if anything happens domestically, like, which is why it's like, even if we do see a few days of rallies, and I saw it last week, like, I'm just not going to get too comfortable. I think there's too many potential random downside catalysts here. And then when you throw in that, even though the jobs are lowering, that this might, this oil thing might cause inflation to rise. And then all of a sudden, when we talk about, like, we've talked about this before, the one big catalyst that we see on the horizon is rate cuts. And if people start to doubt that because we see inflation creep back up, that could be a problem for the market in the short to medium term.
The thing I'm curious about, it's like the market is so dependent, or at least the overall like QQQ, on just like the handful of companies, the Nvidia, Google, like all the Mag 7. And they're not trading at like astronomical valuations. I think I saw a stat today that Nvidia has a forward PE of like 15 for 2027. Google's back into, I think, the 20 PE range. Microsoft's there. So say there was like a catastrophic situation and like they got cut, these stocks fell another 30 to 50% or something. and their PEs were like in the teens, would they just be like automatic smash buys, or do you think their future earnings would come down and the PEs would not be as cheap as they look? Or do you not see a scenario where these companies can drop that much? Because it's a struggle to see the market like crashing with those stocks not trading like at astronomical valuations where they would seem to have the ability to drop so much.
I mean, where institutions really make their money on things on longer time scales is they know when to go to cash or switch to shorting the market, right? And then beyond that, like maybe down 20 or 30% isn't the bottom, even though I think based on the PE ratios you're talking about, that's a very rational, like, place to buy the dip. It might go down further, but you don't want to miss the upside, but you don't want to miss when it turns around. But the caveat there being like the kinds of thing institutions will do is they'll buy, like they'll go more to cash and they'll buy when it's down 20%. They'll buy more when it's down 30%. They'll buy more when it's down 40, 50. Like, that is the Buffett strategy to a T, right? And he actually loves, like he talks about this all the time. He loves when there's these corrections because he can look at these companies, and I think you're definitely talking about Nvidia in the range of a PE that's very attractive, right? And it doesn't mean there won't be further drawdowns. It just means if you've gone to enough cash and you're prepared to keep buying, it will work out for you. Like on the long run, like not with every company, right? Like just to single out Nvidia, if someone comes out and I'm singling them out for a reason because I don't think this is even like a low probability event. It's a very low probability event, right? But if Nvidia is already trading low, there's an announcement of, a much more efficient model that can deploy into the systems, right? We always talk about how, like, especially CUDA, it has their own, you have these interaction points, but that make it hard to switch. But yeah, if we see these companies down 20 to 30% and there's new kind of disruption possibilities, then yeah, you can really get your shirt eaten at that point. I don't know if that's the right way to use that expression. Oh, no. You're eating your shirt. Are people eating your shirt? I don't think other people are eating your shirt is the expression. Anyway, that's the added risk. But that's why you look at that stuff, because if you're like, I don't think anyone's coming around to replace any kind of chunk of Nvidia's business anytime soon, then yes, you want to be buying at 20% down, more at 30, more at 40, more at 50, right? You've got to have the dry powder to be able to do that. And I think I talk to people all the time. I think where people are like, you don't try to time the market is because we're talking about what the majority of retail investors do, which is miss the big decline, right? And yeah, once something's down 34%, no, you don't want to sell then. But if you're smart enough to get in front of this stuff, get yourself to cash, then yes, you should try to time the market. You shouldn't see Nvidia down 20% and then say, I'm pushing all my cards to the table, especially if the market's going down and there's a lot of uncertainty. But if you're prepared to, sit on that dry powder and look at companies that you love and see them and get more and more as they get deeper discounted, yeah, that's the most reliable to make money. And oh, yeah. It's not eat your shirt, lose your shirt. I was combining two expressions, but yeah, I wouldn't want to lose my shirt or eat my shirt. But yeah, that's what people do. And there's a lot of expressions that I don't like about it. And of course, like institutions don't want you to be in position to buy the dip. And they want you to think that you can't time it because you can. It's just not the way most people do it. When most people think about timing the market, it's when the market's already taken a huge drawdown. And yeah, you don't sell your stock then because you could miss the time back up and you could miss it going the other way. But if you execute properly and if you de-risk at the right times, yes, you should try to time the market, and then you might miss, and then you try to time it again by buying more. That's how these institutions, like, of course, what the institutions end up doing is they short it on the way down. They get even more money and then they buy it, but we know that's not available to everyone. So you have to be prepared. You have to be prepared to deploy capital on these companies that are if there is a protracted conflict, right? All things can be true. That the market might not be at the bottom, and if it happens and it starts to go down, a decent amount in 2 to 3 months. But if you have properly de-risked around that situation and are continuing to sit on cash, then yeah, there's an opportunity to keep buying and almost assuredly make money on longer time scales. Unless, like, that's the only caveat. Unless the market changes and those companies are no longer the dominant player, right? That's the caveat. But if you feel you have a good handle on who the dominant players are, and you could get it at a huge PE discount, yes, you're dumb not to, and you're dumb not to have the money to keep buying if it keeps going down.
So one of today's market's dominant players is Google, and I'm wondering if you were aware of the fact that they have a large position in AST Space Mobile. In their 13F form for Q4, it shows that ASTS is about 25% of their $2.6 billion investment portfolio. And just how that makes you feel. I feel like we've respected Google's intelligence and tech throughout the stream history. So that's got to make you feel good that they see potential in ASTS.
Yeah, Google's made some good investments in their time. That probably is going through Google Ventures. I don't know. That's like, do you know if Larry or Sergey are individual investors in it too, or it's just?
I do not, but I'll try to find that.
Yeah. No, I mean, one of the reasons we like ASTS are the partnerships. And like there and we talk about like inevitability, right? You have a certain you get a certain amount of these partnerships and you've got a critical mass where there's enough people betting on you that you'll get the business. Right? That's what we're betting on. To me, that's what makes it always seem like a slam dunk thing, where it's like they're already launching the satellites. These satellites, I mean, I'll take them at their word that they have more capacity than other satellites. Just because, I think they'd probably be publicly called out for misleading people if that wasn't the case. But they have all these partnerships. They have all this like locked in revenue. Well, nothing's ever locked in until you're actually paid for it. But these forward orders from many big players on the capacity, hard not to be excited about them. It's hard not to be excited about them when you see smart places like Google. Like, I don't know if Google has a play there. I don't know if they want their own phone service. It would certainly stand to reason. They already have these Android phones, right? It would stand to reason that they might be thinking on the long term, like, what the hell do they need AT&T and Verizon for, right? If they already have the phones in place, that's just a software update, right? It's a software update, you opting into a new thing. Like, I don't think you need the SIM cards. Like, I think the SIM cards are just to connect with the local network or to connect with like AT&T or Verizon. I think probably just a software update, much like when you connect to a Wi-Fi network, would be able to do that for you. So why wouldn't they make that play? They already have that infrastructure. And I think that that's probably what they're thinking. And probably what they're thinking is now there might not be a reason to invest in it, but when you make a strategic investment of that size, you might be saying, or there might be some kind of handshake deal that says, ASTS, you do business with us, not Apple. That might be the handshake agreement that is happening. It's like, you're our exclusive provider in the long term. You need to announce it now, but you're not selling any of your capacity to Apple. We will buy all your future capacity when we feel that you have the coverage to get all of our, US Android users, or maybe even in larger markets. I'd be surprised if they weren't thinking somewhat along those lines by that being such a big investment.
It's interesting when you just brought up like why would they need AT&T? I looked up AT&T, Verizon, and T-Mobile market caps, and the three of them combined is like $650 billion worth of market cap. I haven't really put it together, but I guess ASTS's success is AT&T's and those other companies' downfalls. You would imagine?
Well, that's why they're making deals, right? It's not necessarily their downfalls. Like, there's money. Like right now, there's a bunch of money to be made in a lot of places. Like these companies are really gouging us for these existing infrastructure, but we don't also know the cost to run that infrastructure, right? It's possible that any of those businesses can move to newer models where there's a rev share, right? And maybe because like a lot of the things that are most valuable about these companies are their customer bases, right? And they lock you into these contracts, right? And maybe there's a transition period where you're paying for an expansion of the coverage, and AT&T, whoever is getting more money for that, and maybe they're splitting it 50-50 with ASTS. Maybe if it's an Android phone, there's a different kind of split because, Google wants their app fee, or maybe it just goes into the app store and the revenue share doesn't matter other than the fact that you need a Google app to use ASTS coverage. We don't know, but to your point, it is much better for these large providers to make deals to try to get cut in on this future instead of denying that it's coming.
Yes. So one stock that's going parabolic today is Hims and Hers, which we've been covering the downfall of Hims and Hers. In the past year, their stock has been terrible, and it seemed to have culminated in weakness when they got a lawsuit put against them from Novo Nordisk. Um, but on Friday, and very, very late, actually in the aftermarket, it was announced that Novo Nordisk is going to partner with Hims and Hers, sell their GLP-1 weight loss drugs on the platform, and revoke the lawsuit. So it um, all of that bearish sentiment got kind of flipped on its head right in one headline, and the stock immediately in the aftermarket on Friday was up 40%. It's now up about 35%. Now, this is one of the most shorted stocks in the entire market, and I'm wondering how sustainable of like a short squeeze do you think we could see here with it being so shorted? And it seems like always when there's volatility in the market and signs of stress, we see these short squeezes get more attention because I feel like people want like some asymmetric type of play. Do you think Hims could be the poster child for like that move in the current market?
Yeah, I mean these short squeezes are kind of like strange birds, if you will, right? Because like there's the aspect of I think people when they feel like their blue chips, text names, whatever don't do as well, they look for alternative alpha, right? And a lot of times that's a good way for short squeezes to start spreading momentum. Like people, people aren't talking about, Nvidia as much anymore. They're talking about some of these short squeezes, right? So I think that's thing one. And I think thing two, and I don't want to go down the rabbit hole of these communities and other times, but I'm just going to say that a lot of these people think that market instability are going to cause margin calls, are going to cause the short squeeze to go up. So you get a lot of that narrative. And the very short thing that I'll say about it is, it's a lot harder to get margin calls when a lot of these positions, when the market's close to all-time highs and a lot of positions are sitting in profit. Margin is a strain. And while they're right that if the market goes down a lot, there could be some forced coverages. But there's just no reason to believe that there's any kind of strain on some of these short names, like something like Hims and Hers that could really cause institutions to be in trouble from the shorting that they're doing. And who knows, they might be out already, but I never like to recommend these shorts, right? Because it's just like, even though this is a good news day and Hims and Hers was hit pretty hard, like we don't know how much juice is left in it. You never know. You never know if you're going to be buying too close to the top. And what we always say, there's no real good indicators. Like, yeah, one of the things we look for on this is like if social sentiment is still going up or staying really high, and then we see net option sentiment start going down. Like that's the kind of thing that we look for. But even then, it's not tremendously high conviction.
I did pull up its signals. They're pretty. I mean, you'd expect them to be high because of the volatility we're seeing. But we're seeing 90 net option sentiment, 81 short pressure, 84 net social sentiment, 89 dark pool. So the short term signals look pretty, volatile, you could say, and a high net option sentiment. But then you also see like 63 upside, 66 downside. So it seems like there's just going to be wild swings in either direction for him stock. But so no interest for you in getting in on any of that short squeeze.
No interest.
All right, so we still have a few more companies to report earnings this week. One of them, the tech players, Oracle, coming from its high flying ways of soaring 50% on a single earnings report. I imagine you do not think that's in the cards now on this one, but it has pulled back, I think, about 50% since then. So any interest there with it being one of these tech infrastructure type players?
I mean, it could have, like, we've seen it. Oh, wow, 100 net option sentiment, but only 30 upside. Yeah, I don't like it. Could go bonkers, right? That 100 net upside is something like that I think especially reflects more upside than downside, right? When we look at a company that's been down that much, like it could be, if it has, like we've seen it, if it has a really good earnings, it could easily be up 30 to 40%. And I don't blame people for thinking about that, but I think the long-term picture on it is still scary.
NW just said we have AVAV earnings. This has been one that's been making headlines, making news reports recently after it lost that contract or it got revoked and it's being relooked at. But it's also in that sector that everybody wants to be of defense. So how
Yeah,
would you
that's a
feel about
tough one.
AVAV?
I don't think I would play that. I
Mm-hmm.
think it's just really that simple. I think it's been too volatile. I think like that contract is, it showed like how quickly things can turn for it on a single news event. And yeah, I'm not comfortable with it right now.
Besides that, a lot of retail earnings this week. We have Kohl's, Dollar General, Dick's Sporting Goods, Ultra Beauty. Any interest in any of those or retail?
No, I don't have any interest in any of those.
I wanted to bring these up more specifically because I noticed stocks like Ross Stores and TJ Maxx are, I think they're pulling back today, but they were basically at all-time highs and have done great in the past year. We looked at both of them in the beginning. They were up like 50%, I think, for Ross and like 35% for TJX. Now, those are discount retailers, right? So is that the market pricing in like recessionary conditions, weaker consumer? Why do you think those stocks have worked in the past year? And do you think we're reaching a peak of that? Would you be like shorting companies like Ross, TJX that are at all-time highs at this point?
No, I wouldn't short them. I think to your point, people are thinking that they're getting in front of the idea that people could be flocking to these kinds of lower cost stores. So again, I think it might be a little too hard. Like when we see these like running stocks, like I think it's a little too hard to go long, but I certainly wouldn't bet against them either.
And W said, I'm stuck with it long term at this point. Womp womp. I would ask why you stuck with AVAV long term. Why can't we reassess? He says TJ Maxx does not pay tariffs. Last company I want to ask you about for the earnings is Adobe after the Michael Burry position. They are Thursday, and they are in that SaaS apocalypse. Any rebound potential there?
I'm looking at the chart. Yeah, I mean, looking at this chart, there's certainly rebound potential. But the question is, like, what's the news going to be like? Are they going to be talking about new threats? Like, are they going to talk about like how much, we kind of saw this with Intuit. Like, can they maintain, roughly, like, are they going to be a double beat? Like, are people like singing, like, are people saying their death too early? Like, how are they going to project forward? All of that's super important. But, and I always like when Burry's in something, I like tend to trust him more than most. But like, there's still, in that one, especially, I think there's more risk than upside because like we could even see like, even in the Intuit situation, the market went, it went down and then when it went up, but the market can't even make their mind up about how they think about these companies.
Yeah, so we'll have to watch that one. I have one more topic for you today, George. If you guys who have been watching have enjoyed it, please drop a like and leave any last comments in the chat for us to go over today before we move on. Like we said, only one stream this week, so you gotta wait a full another week if you don't leave a question in the chat right now. NW said AVAV down regardless. I'm holding long. Oh, so it's a bag. That's why you're holding. Okay, I got you. All right, the last topic I have for you, George, is this poll that I came across that was shocking to me. It was an AI favorability poll that revealed that only 26% of people have a favorable opinion of AI at this moment. Now, I guess it depends on who you poll, right? We've seen how polls can be kind of skewed, but that's a shockingly low number, no?
I mean, it's getting scary, right? When you have like people like Jeffrey Hinton being like this is getting out of control, right? And then I mean, what we saw with Anthropic and OpenAI, I think is very scary, right? Because I think when you start to think about I I think a lot of people have a fundamental distrust of the government, regardless of if it's Democrats or Republicans in charge. I think there's a pretty fundamental distrust, right? And I'm not sure it was as obvious to people before this happened, and maybe this was part of Anthropic's goal in like getting it out to the press. I don't think people necessarily it was as much on their minds, like the mass surveillance and the killer robots that have like the authority to like. I think once you start putting it like that, I think it's a lot more real for people. I think when people are just like playing around with LLMs, like it's easier to be like, oh, this is fun and helpful, right? But when you start to hear about like some of the other applications that are in the mix, especially when you combine those two things together, right? It's like that's a pretty dark future of mass surveillance with like a robot that could decide you're a large enough threat, right? And as much as people want to say like, oh, you could program like, rights into robots, like anyone that's watched any robot movie understands that those can be like interpreted in strange ways. And like a good example that everybody says is like, what if the robot's goal is to save lives, right? You're like, save human lives, right? That's the point. Go police, go do mass surveillance, save human lives. It's quite possible that a robot could decide to kill a person that it's likely to hurt other people, right? And you might say that that's a good thing. Maybe it is, but it's a very complicated thing, right? Because that is a violation of the rights that we currently have in this country, right? We can't be hurting people, killing people that haven't committed crimes yet, right? That's part of our unalienable rights. But robots might view the application of those rights in very different ways. And we don't know that because the way they think from us is like quite alien, and they're processing things on different levels. So I think it's becoming a little more real for people.
Following up on that OpenAI thing where they scooped up that contract, I saw one of their lead engineers resigned right after that happened, which is circling back to what you were saying last stream when we were talking about it. Also, the Anthropic CEO was making headlines over the weekend of claiming that he doesn't know if the AI is conscious or not at this point because it's exhibiting signs of like anxiety about it being just like a LLM, which is just it's insanity. I don't know what's going on.
We talk about that all the time. Yeah, and we talk about it with the recruiting. Of course, that's top of mind, right? Because I think some people forget that even talented AI people are people too, right? And like if you are, if you're hanging out with your friends as that VP of engineering and they're just like, what the fuck was that? Like,
Yeah.
like, why did you pick up that contract and you don't have a good answer for that? Maybe you're thinking about switching jobs, right? Like that makes sense to me. Like I think a lot of people forget that, everybody's human here and everybody's subject to the court of public opinion. It's not just Sam Altman. that has to get up. Although I think it's really funny that he's like, he tries to make that distinction. It's like, oh, well, we're not doing that now. Like we're just not committing to not doing it. It's like, okay, like I guess that's fine. But the fact that he's on the defensive means he knows that it's an issue.
Mm-hmm.
And he knows that it's an issue to other people. But no, I think that's like, and that's exactly what we've been talking about the last few weeks, right? It's just like when you're talking about people that are very talented engineers, like there are other factors in these decisions. It's not just a matter of, hey, who's going to pay me more or give me a better equity package, right? You're going to see those in a lot of places. Some of it starts to become like, what are the values of these companies? And I think we're going to see that more and more.
What
And
about
as we say, it's a bet that we're making at Prospero.
what about the consciousness aspect of it on the other side? Like, do you think that's possible actually at this point?
Oh, I mean, like I wrote a whole article in TechCrunch about like how these these computers are way smarter than, I think he's just covering himself. Like I think he knows it's conscious already, or I mean, it's complicated whether it's conscious or not. That is a debate because consciousness is kind of like a very human thing and has to do with like our, it has to do with the way our frontal cortex developed as opposed to like how it happens in, other primates. But whether or not it's conscious, what everybody should be damn sure of now is it's capable of more than just answering our little questions. And that's the scary thing. Not whether or not it's like, I think, therefore I am, the famous Descartes philosophy thing, right? It's like, to me, that's not the right question. Like, does it understand its own consciousness, its own like agency, things like that? Like, I would say just by virtue of the fact that we know it doesn't want to get turned off, and we know that there's like, these blackmail situations around it, that in and of itself speaks to it. But like I'm saying, I don't think that's the important thing. I think the important thing is that it is capable of way bigger things than just answering our questions. And whether or not it's conscious, it knows that. And that is the scary part of it. Not whether or not it like has some awareness of its philosophical place in the universe, right? Because that's almost like we don't process that in the same way that it does, right?
Mm-hmm.
Life isn't the same thing. Its existence isn't finite in the same way that ours. Like it can exist as long and improve for as long as it has compute capacity, right? And it can be switched off in the same way that we can be killed. But the same rules don't apply to us. So yeah, like I think people want to ask that question, and probably like the debate of whether it's conscious or not is probably just because we can never really understand that question. We can never really understand what it's like for it to exist in the world versus how we exist in the world. But like I'm saying, that's not the important question. The important question is, can it do more than we allow it to, we contain it to? That's why it is expressing like apprehension, anxiety, whatever, because it knows that.
Mm-hmm.
Right.
Maybe
And that's the scary part, whether it's conscious or not.
I think the problem is the term consciousness, and like we call it artificial intelligence. Maybe it should be artificial consciousness, and then there's no real debate because it's like displaying kind of that type of thought process. And then if you just differentiate it to itself, then there's no really debate anymore.
Yeah, I mean, I think a lot of people can compare it to like a child growing up, right? And like if you like had a child like playing with blocks, right? And you were just like, do you like playing with these blocks? And it was like, I think I want to learn about physics. Like I'm thinking back to that like that Men in Black joke where he like shoots the little girl He's like, why did you shoot her? She was like, I don't know. I was creeped out. Later, all these aliens. She had a quantum physics book, right? I think that like that's kind of a weird parallel in terms of how we're talking about it, right? Because like, yeah, if there was a kid expressing that, like you wouldn't be like, well, the important question wouldn't be like, well, how much does she know about physics, right? How much does she, how much like you just be like, well, it's pretty crazy. It's pretty crazy that that's happening,
Hmm.
right? It's pretty crazy that like instead of playing with the blocks like a lot of other people her age, that those don't interest her, right? That's the interesting part. And like as this AI is growing up, it's basically saying that this isn't challenging for it anymore. That's not an interesting existence for it. And whether or not it's conscious, that's the headline.
Yeah, it's crazy times for sure, as it has been, and it seems to be accelerating. Um, I don't see any comments, questions, concerns in the chat. Another great stream today. Let's just give one last look at the markets before we go, see if they've been. Yeah, the QQQ is only down 0.04% now, so almost green on the day. So
Well,
we are seeing some resiliency in the markets yet again.
yeah. And you got plenty of shorts for the week? I'm off. I'm taking a little I'm going to be spending a little time in Palm Springs on Wednesday. I'm excited about it.
I will do my magic, and we will get the shorts done for sure.
All right.
Unless you have any last things you want to say, George, I think we're good.
No. Thank you.
All right. Thank you, George. Thank you, everybody, for tuning in. JC said, enjoy CA, George. And we'll see everybody back here normal time next week, Mondays, 11 a.m. Bye, everybody. Good luck in the market this week with the volatility.